Hi everyone, welcome to the Eagle Rock Diversification Fund webinar. And before we get started, just want to make sure we cover the legal stuff. I'll ask you all to read the disclaimer on the slide. Essentially, what this disclaimer states is that since this is a regulated opportunity governed by the laws and guidelines of SEC, the information contained in the presentation is confidential and is solely for the purpose of providing information and education to the prospective investors. As such that this is not open to anyone that does not have accredited investor status under Reg D 506C. While the details are pulled together from accurate sources, investors are encouraged to conduct their own investigation analysis on the information presented as well. So the agenda today is to go over the assets overview, introduce the team, the projected returns, and also highlight some of the great things on the assets that we love and why this opportunity, and also include the next steps as well. So this is a projected 5-year hold fund with a minimum investment of $50,000 covering 3 different assets. So I'm just going to talk very high level at this point. All 3 assets are chosen very strategically to diversify across not just locations, sponsors, and also business plan as well. So the first one is in Tucson, Arizona. As you know, Tucson is a very strong and hot market. It's rated as number 2 best places to live by Outside Magazine 2018. It's also top 10 cities best positioned to recover from the coronavirus as well. And also we have Houston, Texas. It's number 4 city in the apartment demand increase in the secondary markets. And it's also the number 5 city, trailing New York, Los Angeles, and Chicago in terms of city population. We also have Raleigh, North Carolina, where it's number 2 in tech job growth in the last decade. Raleigh is also very booming as well. So all 3 locations are very, very strong in real estate and population growth. The first asset in Tucson is called Misha Antigua. This is a Class B plus. 75% of the units has already been renovated, but the operator just has kept the rents really low to maximize the occupancy. So there is a huge upside to this deal, and we can execute that upside in a timely fashion as we turn over the units and renew the leases as well. The second asset is in Houston, Texas, the Sarah at Lake Houston. It's a flagship property, as I like to call it. It's a Class A plus, and we just got it off from the developer, and that means that there is a lot of potential for rent growth because developers typically try to fill the units as quickly as possible with a lot of concessions and lower rent as well. The third one is Timber Hollow in North Carolina. It is a true value add property, a little different from the other 2. 1987 built, with majority of them still being classic conditions. So this is such a value add opportunity, and the forced appreciation potentials is going to enable the possibility of selling in year 3, which is what we're projecting here. So next is the intro. We have Flint Jameson here. He's the CEO and co-founder of the Eagle Rock Fund Diversification Fund. He's got 4 years of experience and 750 units, and by day he's a program manager and runs a $120 million aircraft modification program. And we also have Jennifer Joyce. Very, very excited to work with her. She's our advisor on this fund. She has 2,500 doors of active assets under management. She also has $100 million blind fund that she's running as well. She's an advisor, and Camila is also a co-founder as well, with her 20 years of real estate investing experience and over 1,000 doors as general partner as well. And here's me next, and I am the director of operations in this fund. I have 158 units through my company, Life Mission Capital. And most of you know a little bit about me as well. And here's the rest of the team. So about this deal, that it is projected to double the money within 5 years. Double money within 5 years with a spend of 1.87 to 2.1 and a 7% pref return. While there's no guarantee with any investment, this is the closest to guarantee that we can give you with a 7% pref return. And that means we'll pay you, the investor, 7% of the investments before we even pay ourselves. And this equates to about 17 to 90% annualized average return and a 15% IRR. And then we'll also have an 80-20 split on the investment as well. So moving on a little bit more, we'll have a fund management fee of 0.5%. Fund expenses are up to $25,000 annually. And we did our due diligence on all 3 locations. And that fee is 1.5%. Next slide about cost segregation. This is an exciting part because a lot of us invest in real estate for the tax benefits as well. So the properties are going to pass through their tax savings to our investors. So for an example of a $100,000 investment into a fund, investors can expect anywhere between 60 to 80% of estimated year 1 paper loss through bonus depreciations. And that is exciting because 2022 is the last year for 100% of the bonus depreciation tax law to apply to investors. So we encourage our investors to take this year very seriously in their investment strategy. We'll also finalize the bonus depreciation by doing cost segregation studies on all 3 locations, and the finalized numbers are set to exceed these projections after we hear back from engineers. This is their conservative pro forma percentages prior to closing all 3 properties. Next, to understand the fund cash flow, here's some high-level numbers to dig into for the investors. We are partnering with our fund manager who's raising $46 million for these 3 locations. And we have negotiated our investors we'll have negotiated for our investors to get better returns than going directly to these locations. So I have a fund where we're raising $5 million, and based on this pre-negotiations that I mentioned, we had with all the different operators, your projections are going to look like this. So for the life of the investment, for investment amount of $100,000, we'll have a 7% pref return that we mentioned earlier on the 5-year time horizon of the business plan. So that equates to about 7% pref return times 5, which would be $35,000 on your initial investment. We also have 3 different locations that are going to sell in a 3 to 5 year period. So from those sales, after we catch you up on the pref return, we'll pay you an 80-20 split. So the investors will get 80% of the profit, and the fund manager will get the 20%. That's after we catch up on your pref return. So on a $100,000 investment, this equates to $52,098 to start the sale of the property for a total of $87,098. Now, at the time of the second and the third sale, we'll also return your initial $100,000 investment. So you will receive over the life of the project your $100,000 plus your $87,000 in profit. That's a total of $187,098. That's a 1.87 multiple, equity multiple, based on our projections. Now, down at the bottom here is the year-over-year projections of the cash flow in the fund. We're taking initial investment of $5.075 million, and then it shows the pref starts accrual. If we're unable to pay the pref in the year 1, then it'll carry over to year 2 and so on and so forth. We'll catch up your pref. So at the time, any capital event you see here in year 3, for example, the sale of the first property that we project here, will catch up the pref in its entirety, and then it moves to 80-20 split. And then after your investment is going to stay for the life of the project, then you can continue in year 4 to accrue 7% of the initial investment, which will be paid out on the cash flow available on all the 2 locations that are left. And if we owe any pref, you'll see that the year 5, at the beginning of the year 5 balance, any pref that is due will be caught up at the time of the assets 2 and 3 being sold. So after we paid all the pref with the asset 2 and 3, so in year 5, then it's time to return your capital. Once we've paid off our capital investments, we'll split the remaining of the profits on the 80-20 split. So I know it was a lot of information I just went over. Feel free to re-listen to this part, and all I've mentioned is also displayed here as well. Next, we're going to deep dive into each of these properties. So this is a shortened view of the deck. As I mentioned earlier, you will receive the full copy of the deck and the investment summary in the email. And you can dive into all those details at your own time, of course, but I'm just going to hit the highlights here. For the first property, Misha Antigua in Tucson, Arizona, this is a 248 units. 70% of the units has already been renovated to a premium status, like mentioned earlier. Sorry, the slides weren't moving properly. Here we go. Yeah, so the current owner is very concerned about the occupancy than hitting the market rent. So there's already an upside of $290 per unit that we can start working through from day one by just doing the renewals. And beyond that, we can also do more value add to the remaining part of the property as well. It is a 1989 vintage, 248 units. The current rents are at $1,055. We're looking at a rent premium of $290 for the interior and exterior renovations. And the capital expenditures are listed here. So we're working on a few things like improved roofs, improved pool, adding new signages, securities, some locker updates with the clubhouse, offices, and dog park and barbecue area for the residents as well. And the second property is Sarah at the Lake Houston. So this one is a beautiful property, brand new, built in 2020. Now, the interesting business strategy about this one is that when you buy this straight from the developer, and developer typically try to fill the units as quickly as possible after they build it. So it usually means there's a lot of concessions when they fill the units, like first, last month rent for free, or free internet, a bunch of other stuff. And that is really to incentivize people to move in as quickly as possible. And it also means lower market rent. So from day one in acquiring this asset, we can start doing new leases and new renewals and the market rent to increase the revenue as best as we can throughout the first year. The property overall is also already cash flowing very well. And so this is a 350 units built in 2020, and average rent in place is $1,487 versus $1,591 in pro forma that we have. So we can have about $113 in rent premium. As for the capital expenditure, we will be working on improving the property management, burn off loss to lease, and etc. It's not a lot to do. It is a new property, so our capital expenditure budget is relatively low, around $250,000. But we'll be working on a few things to also increase the revenue as well, like adding private yards, storage units, valet trash, internet, etc. And also do utilities chargeback with the tenants as well. So the next property is Timber Hollows. This one is in Raleigh, North Carolina, a booming market as well. It's a Class B property. What's different from the other one is that it is a true value add. So this property is in the awesome location. It's very close to UNC and also Duke University. In fact, there's actually a satellite campus that's being built right across the street. So there's a huge potential for a lot of higher education tenants coming in as well. We'll go in and renovate this true value add property, put forced depreciation on it, and get those rents up to the market from a more premium unit standpoint through the renovations. So with so much forced depreciations that can happen in the first 3 years, we're projecting a sale in year 3. So here are some of the stats about the property. 108 units, 1987 built. The current rents are at $1,153, and we can see a rent premium of $270 after we'll have the units renovated. The capital expenditure budget is $8,000 per unit. We'll also add technology packages, reduce expenses through the improvement of the different maintenance, such as water heater, HVACs, and etc. We'll also be improving the curb appeal through the capital expenditure budget as well. So what we love about this deal is diversification and location. So diversification across 3 top real estate locations in the US: Raleigh, Tucson, and Houston. So we love that. And also it is Class A and Class B, and it has very strong returns as well, especially with the opportunity of at least $113 rent premium that we can have through our value add play, especially with a value add play in Raleigh market. We'll also get to have our investors take advantage of the huge tax savings that we'll be able to generate for them through the cost segregation studies and the bonus depreciation studies as well. And overall, our sponsorship and partners on this project is very, very strong. Experienced sponsor team with over 10 years in the real estate investments area. And the property management company is also very reputable with strong track record as well, which you'll see in the investment summary. So some people may ask, why don't I just go straight to invest in those specific properties? Why investing through a fund? Well, for one thing, by investing in the fund, you have access to all 3 assets with just one investment. Not only you get to spread your equity across those assets, you can also balance your risk through the diversification as well. And as we mentioned, those are not just any 3 properties. They were chosen very strategically for their locations, sponsors, and also business plan as well. So all those diversification will really help you minimize volatility in your portfolio, especially if there's any changes in the market as well. In addition, you'll get exposure to more assets and more markets, and those are just not just any markets. They're some of the fastest growing markets in the US. And of course, with the tax benefits we talked about, will get passed on to you as well, and all those assets in 1 ppm to review and sign as well. So let's talk about who can subscribe and some of the logistics. Again, this is a 506c opportunity, which means this offering is only available to accredited investors. So class shares are a minimum of $50,000. However, you can certainly invest more than that. And in terms of funding, we accept cash, self-directed IRA, solo 401k, EQRPs, or any combination of them. And most importantly, this is a first-come, first-serve opportunity. In fact, at the moment of this webinar, we're currently oversubscribed on our soft commitments. So we encourage you to reserve and send your funding as soon as possible. In terms of the process, so first, this offering will be available for the next 3 weeks in May. If you're interested, you'll want to go to our investor portal at Life Mission Capital and review the PPM, decide how much you want to invest. Then commit by reviewing and signing the PPM. Once you sign the docs, we'll send you funding instructions. We'll also verify that you're an accredited investor in our portal. Once that step occurs, you'll send your funds and secure your spot in the deal. So until your funds are wired to us, your spot is not secure. Again, as we mentioned, we're currently oversubscribed on our soft commits. So next, we will expect to close the fund in May. After that, we'll send you regular updates, especially right after we close as well. Distributions quarterly as well. So if you have any questions that we did not cover in the webinar, or just want to ask about the things I've already mentioned, feel free to reach out and let me know. You have my email address, missy@lifemissioncapital.com. And thank you so much for joining us tonight on this webinar. And I'm really looking forward to partnering with you on this amazing opportunity. It's very, very exciting, such a great diversification. So thank you again. I hope you have a great evening and talk soon.